Today, I want to ease your fears about the stock market crash. So, I don't know how many of you remember, but in 2008, we had a very, very large market crash, and it looked like it started in '07, in October of '07. And let me get my drawing tools. All right, so we are looking at the S&P 500. I'm currently on the weekly time frame, and I'm actually looking right here at the date. If you remember, we at the end of 2007, we started a pullback. I don't know how many of you remember the 2008 crash, but we had a very significant crash in 2008, and we went down for about a little over a year. And this was very, very major at the time. Looking back on it now, of course, it's not, because if you see the run up that we've had since 2008 has been extreme. But at the time, it was very, very significant and people were panicking. I was not trading, but I remember the housing market bust, and it wasn't very good for a lot of investors, but it was good for some new investors like myself. It was good for newer people coming into the market, as well as new first-time home buyers. Welcome to the channel, everybody. My name is Mal. I am a day trader, and I am also an investor. If you are new here, it's good to have you. And if you've been in here before and you enjoy these videos, welcome back. My channel is focused on helping beginner traders get started and providing information I wish I had when I started trading some years ago. All right, so we're looking at the weekly chart right now of the S&P 500. And right here, we are currently here. We've had this massive sell-off. So what I want to do is I want to look at this from a bird's eye view. What I did was I went to the weekly chart. I'm also on the Spider ETF, and I'm on the weekly chart right now. We could probably look at the monthly chart, and it won't be as bad. I don't know if I can get a monthly on here, so let's see if we can add a time frame. Month, okay. All right, so let's go to a 20-year monthly and see what that looks like. Okay. So this is the 20-year monthly. We've had a very, very aggressive sell-off here, which is obvious to everyone. So the first thing I'm looking at is right here. Starting in, I'm looking right up here on the left-hand side. So starting from about February right down, of course, this is March 19th. So for about a month, a little over a month, we have dropped down quite a bit. Right now, we are sitting on a major area of support. So if we're looking for support, the line of support that I would put would be right here. This is the most recent line for me, would be right here. So it looks like we came down, we broke through it, right? We came down here, we broke through it, and then we kind of bounced back up. So time will tell what the market's going to do. But what I want to do is I want to look at the overall picture, because I know a lot of people are panicking. So I want to look at the bird's eye view here, starting in 2007, which was right here. So we had this huge run up, and then the housing market crashed, and we had this major sell-off. And at the time, this was a gigantic sell-off. Let me get my crosshairs. So if you look all the way to the right, the S&P was roughly at $157, $158. That's kind of where it topped out, right about this 160 area. And then it sold off all the way to 71. So we cut the market in less than half. In about a year, a little over a year, the market got cut in half. So people were panicking. I remember this crash. I wasn't trading at the time, but I remember it. As a matter of fact, we actually broke this area of support here. So if you're looking at this, we broke this area of support, and people were panicking. And then as soon as we broke it, we bounced right back up. This was a major, major deal from the end of 2007 right to the first quarter of 2008. We had this huge sell-off. And then look at what it's done. Look what we've done since 2008. I remember this. I also remember the Y2K crash. This was a huge sell-off as well. And people were panicking. So this current market sell-off right here is nothing new. This has been done before. It's extremely aggressive, so it's causing panic in the markets, which is understandable. If it had, let me get my line. If it had chopped around, if it had done this, this would be more understanding if it just kind of went sideways and then started to recover, and then we kind of started chopping upwards. This would have been a much better, much easier on everybody's mind, right? But because it's so aggressively down, it's very, very hard not to panic. And of course, investors and seasoned traders were expecting this, and this does not come as a shock. So time will tell if we break this level. If we do, the next level of support is right here, all these pin bars, right about this 180 area. And this is something that I wanted to talk about earlier. I honestly didn't think that we would get down this far, but now that we have, this is nothing to be worried about. And in my opinion, just write it out. As a matter of fact, I'm buying more stocks. I have a stock portfolio that pays dividends, and I'm buying more stocks. So I wanted to ease your mind, because if you look at this overall, this is where, if you know how to use Fibonacci retracements, this is where Fibonacci retracements come in. We come down over here and grab our Fibonacci retracement tool. We grab our Fibonacci retracement tool, and we measure from this low here to the high. And I'm using as an extension right now. So let me edit the properties. We can take these out. These are my extensions. And then we can add our 3.82, 50% retracement, and the 61.8. Those are our major Fibonacci levels. And what we can do is we can stretch the chart out. And I want to look at this. So here's our line of support. So let me clear this. So the way it works is Fibonacci retracements measure retracements from the low to the high. So you're taking it from this low here or this low here. It doesn't really matter. They're all kind of roughly the same. From this low to this high. And you're saying, okay, how much of a retracement did we get from the low to the high? And as you can tell, we retraced more than 100%. We came up, and then we gave it all back, and then we actually broke this low. If you look left, structure always leaves clues. We broke this low here. We actually broke it, and then we just ripped, and you can tell it was huge. So this whole panic sell-off in 2008 was a good time to start buying up dividends slowly, or buying up shares if you're holding for the long term. I like dividend paying stocks. That's what I invest in. So for me, I'm a buyer right now. So we can do the same thing here. We take this and we drag it. And what we can do is we can go from this low here, because this is the initial low after the rip. And we go right up to the high right here. So this retracement falls into the 38.2% area, which is nothing to be worried about. A normal, healthy retracement is 50%. The only difference is we've been on this massive bull run. We went up here. We had a small, very small retracement. And then we had another massive bull run. So we've been on a huge bull run since 2008. And this retracement to the 38.2 is normal. I would say a 50% retracement is normal. So in my opinion, I think we will come down to right about here. Let me clear that. So what I'm looking at, this whole area of support right here, we got rejection of lower prices, rejection of lower prices, rejection of lower prices. So I think in the next month or two, I think we were going to come down to this area. And if you notice, we have our 200 moving average. This is the exponential moving average. The orange line is my 200 EMA, and I'll put that in the video as well. So my opinion, I think that's where we're coming down to, is right off the 200 EMA. The only concern that I have is because of how fast the sell-off has come. If it was a little bit slower, it would be fine and nobody would really say anything. They would say this is totally normal. So I hope that eases your mind a little bit. If you're unsure and if you're concerned, step back and take a look at the overall picture. Go to the weekly chart or go to the monthly chart and take a look to see what's going on. There's obviously panic going on in the markets right now, but I think in another month or two, everything will settle down. There's a very strong area. If I were to draw a box, starting from these low wicks to the bodies of the candles, I would say the area of support would be right about here, from this 180 area to about the 195 or so. And then you can start looking for confluences. You have rejection, you have the 200 EMA right here. And by the time we get down here, the EMA will pretty much be flat. So then it should kind of flatten out and it'll be around here somewhere. So this will be, if we make it to this area, it'll be a good, very good place to buy. If we break this level, I think the next level we'll retest is this level right here. See all these tops? This is the next level we'll retest. And if that breaks, roughly 220, 218, if that breaks, if we come down and bounce off of this, we might roll over and come down here. And then we'll probably chop around for some time and then we'll start recovering. So that's how these things typically work. The market works a lot on fear and greed. And fear is much stronger than greed, so we have this massive sell-off here. All right, so if you're concerned or if you're wondering, take a step back, look at the bird's eye view and figure out what exactly is happening. And the retracement is completely normal. It's just came extremely quickly. I wish it was a little bit slower, but it is what it is. All right, so if you like this type of video, let me know. I hope this cleared up some misconceptions, and I hope I addressed some of the fears. As for trading, trade like you normally would. Just probably give yourself a little bit more wiggle room on stops because the volatility is really high. So I'm still looking at trading gaps. That's what I normally trade, and I'm still trading like I normally trade. And as far as investing, I'm starting to scale into more positions now and get my average down. This will recover just like the market crash in 2008. Everybody thought it was horrible. But if you step back and you look at actually what happened over the past few years, it's nothing to be worried about. It's just unfortunately part of the process. I hope you enjoyed this video. If you did, hit the thumbs up button, telling the YouTube algorithm that you enjoyed it, that there's quality content in this video so it can get recommended and help more people. And also, if you don't want to miss the next episodes, hit the sub button, hit the bell icon. YouTube no longer recommends every video just because you're subbed. So if you don't hit that bell icon, you're going to miss videos. So if you're enjoying this and you want to follow along, go ahead and hit the thumbs up, hit the like button, and I'll see you in the next video.